right, everybody, welcome back to another video here on Financial Friends. I want to say thank you for joining me today. And if you want to help out the YouTube algorithm, go ahead and hit that like button real quick. And if you're not subscribed and you want to join the friend group, go ahead and hit the subscribe button and then hit the little bell right next to it. That way you can be notified every time a new video comes out. So without further ado, we're going to go ahead and hop into today's plan. We are first going to cover why I did not add anything to the portfolio this week. Then we're going to have a little bit of an update on some earnings, as well as go over the main topic of this video, which is why I love dividends. So definitely stick around until then. So yes, I did not add anything to the portfolio this week. Shame on me. First off, I should have some type of recurring investment set up. That way we are adding every single week. However, I have made up in past weeks for our year-end goal, which is to make sure that we're investing at least $10. So I'm still on pace, but this has just been a very busy week. Life happens, things happen, and I did not make any investment this week. Now, again, with making no investment, you can see dividend yield is the same, annual income is the same. Everything is pretty much the exact same. As we have left it, previous to last week. I did go ahead and do a ton of research. I've been paying attention to the news and things like that. And so if you have not seen This Week in Finance, which was really the reason that I did miss, investing this week, I was pretty busy kind of following everything. Go ahead, check that out. There will be a link in the description. It is like a news sort of style podcast. I'm very excited to dive into that. But because of all of that research and paying attention to earnings and such, we did go ahead and collect a little bit of information here on this earnings, and that was for Johnson & Johnson and 3M. So they went ahead and reported earnings last week, and Johnson & Johnson had a EPS, or an earnings per share, beat by just a penny. So pretty much what analysts had expected. Although their sales did miss, they were up from what they were a year ago. So the expected sales revenue did not hit. However, it was up from a year ago, so we're still growing year over year. Just missed that expectation of what was expected. And then in regards to 3M, $2.31 per share versus the expected $2.01, which you could say was pretty much a success. And they had $1.5 billion in free cash flow versus the $1.3 billion that was expected. So some pretty good results off of both of those companies. And we will be paying attention in the coming weeks as well as more and more companies do report. Now, something that I want to touch on here, part of it, it'll kind of tie all in to why I like dividend stocks. And that's really the companies we have in here. You notice that they're pretty boring, but there is an aspect to them being boring that is beneficial. And that's kind of what sparked the whole idea for why do I really love dividend stocks. Obviously, if you've watched the market at all, or if you've watched This Week in Finance, you will know that the market has been extremely volatile over the past couple of weeks in regards to inflation and fears around, the illness that is continuing to still go around, supply chain issues, and the rate hike that the Fed has been talking about, which is coming in March. However, today, filming this Monday, January 31st, the market was green, as you can tell. So lots going on. Up and down, up and down, up and down last week. Up again today. What is going on? Why do I love dividend stocks? Why do I not care about all this volatility? Let's go ahead and hop in to the presentation. So let's go ahead and open this up. So here is why I love dividend paying stocks. They pay me. That is going to be the first thing. First and foremost, dividend stocks, they pay you dividends. Dividends will allow for that compound growth that many investors talk about. It is the eighth wonder of the world. Dividend growth and compound growth is fantastic. So you purchase a company, that company pays you, you automatically have it reinvested. Your share, your stock in the company grows. Then they pay you again off of that larger piece of the pie. And that gets reinvested. Now you have an even larger piece, which they pay you, and then a larger piece, and it continues to grow and grow. I do have a video all about compound interest. It will be linked up below in a card, or above, I'm sorry, not below, above in a card somewhere. Go ahead and check that out if you want to learn a little bit more about that. And then what I mean by this later then turns into income, well, if you have these dividends and you're reinvesting them to grow your position over time, then at some point when you're nearing retirement, or you're getting a bit older, or you just want to kind of flip the switch and instead of reinvest, you collect that money, you can do that. And the goal is to grow this into genuine income. So a lot of people will say, the 4% rule, you can withdraw part of your portfolio, assume the growth, and kind of move like that. Well, if you're investing in solid dividend-paying companies, something like Coca-Cola, Johnson & Johnson, 3M, they've consistently raised their dividend for 30 years. Well, you're going to hope a few things. You're going to hope that they continue to pay the dividend in general, but also the company is still doing well and they're continuing to raise it. So every year, you're getting a pay raise because they're going to raise the dividend and pay you, raise the dividend and pay you, raise the dividend and pay you. And if throughout your life you've built a substantial position in these companies, well, then you reinvested those dividends as they were growing, and now you are collecting them, and you can be raking in thousands of dollars a year in dividends. And if you do this with multiple stable companies, you're diversifying your risk among companies, you're collecting more money, you're getting paychecks from a bunch of different companies, and that is really what the core goal here is. And it seems boring because again, we're not investing in exciting companies, but this is what's going to be beneficial throughout the road, building compound growth and turning it into income later. So, moving on, they tend to be more stable. This is kind of one of those things where if you're worried about being in the market because you're invested in high beta, which you will learn about here, the low beta stocks. If you invest in high beta or high volatility stocks, I'm invested in a few, Rivian, SoFi. These are ones I mention constantly. I don't even really know a ton of the other ones because I don't really dabble in that. I know, again, Robinhood's kind of been one that's been up and down. Coinbase was one that's been up and down. So if you're playing in these stocks, your position is fluctuating rapidly and quickly up and down. Tesla's one I know that many people are familiar with. So low beta stocks obviously tend to have less volatility. Now, diving a little bit more into what this beta is, if we hop into here, we could see that there are a few types of beta values. So beta value 1. 1 is the middle. 1 is the smack dab middle of the road. And it means that the price of a stock is relatively correlated with the market, or equal in this case if it is 1 to the market. So market, or S&P 500 is kind of what we can use, moves up 5%, your stock moves up 5%. S&P is down 5%, your stock's down 5%. But what we're going to focus on, and we're not going to touch on this is what I meant more in regards to SoFi and Rivian. If you want to pause the video, read that paragraph, you're more than welcome to. But beta value less than 1 is a majority of the companies that we are investing in for dividends. So that means that the market, say, goes up 5%, we might only gain 3%. Market goes down 5%, we might only lose 3%. And this is where it becomes beneficial to kind of keep your head on straight and understand everything's going to be okay. So if we take a look at our biggest holding here, SCHD, the kind of dividend-focused, ETF, 0.75. If we go ahead and move back, probably should use that back button, and we look at Johnson & Johnson, you will see they have a beta of 0.29. We'll go through a few of the other ones. 3M, 0.48. O, the Realty Income Corporation, 0.64. And Waste Management, 0.55. And then Apple does have a bit higher of a beta, and they're going to have a 1.33. And I'm not sure if FizRox is going to show, but we'll go ahead and try it. And it doesn't. But FizRox is going to try and really just mimic exactly what the market is doing. So it is the market in this case. All right. So moving forward, you could see again. Well, didn't want to go there. I apologize. Wanted to go here. Low beta stocks are what we have in our portfolio. And in general, our portfolio is going to be relatively low beta. I guess if I could average all those together, we're probably going to fall below 1, even with Apple being above a 1.33. So I kind of enjoy that. It means that my portfolio is not going to go up and down and up and down. It's going to stay a little bit tighter in regards to how the market is fluctuating. What kind of ties into this is their products are needed all of the time. Waste management, garbage always needs to get picked up. Johnson & Johnson, medical devices, pharmaceutical products, consumer healthcare products, they're always needed. No matter if the economy is booming and thriving, people still need to buy Motrin. If the economy is terrible and people are doing awful and jobs are being lost, unfortunately, people will still be purchasing Motrin because they're going to need that product. The same thing goes for 3M. They make things like masks. Those are pretty much going to be around forever now. They make things like command strips and tape and other things, reflective products and such. Those type of things are going to be needed all the time. They produce a lot of, items, different products and random things, scientific sort of based things for companies and big corporations. Those types of things are still going to be purchased, maybe not at the same rate, but they're still going to be consumed. And so the same can go for products like companies like Pepsi and Coca-Cola. And there's one on the tip of my tongue, Procter & Gamble and Colgate. People will still be consuming their products. Now, if you take something like Apple, for the most part, people are always going to want, I hold these things up all the time, people are always going to want these things. But they might not have the money to buy them because they're going to need to purchase toilet paper and baby products first in general. And then they're going to upgrade to the new iPhone. Then they're going to purchase the new Apple Watch. So I enjoy the sort of mental aspect of understanding that my companies, their products will always be in season, in style, no matter the way that the market or the way that the economy or what type of economic cycle or what part of the economic cycle we're in. And lastly, they rake in money. Let's face it, companies exist to make consumers' lives easier, but they really are in business to make money. Johnson & Johnson is a healthcare company. They try to make consumers, or the people that take their medication or prescriptions or medical devices, they're making their lives easier. Without Johnson & Johnson, people wouldn't have a fake metal knee. People wouldn't be able to, relieve their stress, or not their stress, relieve their ailments or whatever might be, stressing them out. They're making their lives easier because they're fixing and healing their ailments, and they're providing them with medication and medical devices and things to wash your hair. But they're making money off of those things, and ultimately, people will always need their lives to be made easier, and consumers will always consume, again, regardless of that economic cycle, and so they will always be making money. Also, I prefer to invest in businesses, not stocks. What do I mean by this? Let's face it. At the moment, a company that I invest in, two that I invest in, SoFi and Rivian. I believe long-term, these companies will turn into flourishing businesses. That's why I'm invested in them. But at the moment, they're not. They're not making money right now. They're not profitable. So why am I buying into a stock or a company that is not making money? It doesn't necessarily make sense. Now, we can all rationalize it because, again, we're investing in the business because we believe long-term it will be successful. But if I'm trying to build a portfolio generating me dividends, generating me income, staying stable, these are two things we said we wanted to happen. We wanted to grow a portfolio through dividends and keep it relatively stable. Investing in companies that don't make things that make them money is not a good plan. Let's just be, putting it in the most basic terms. Rivian makes cars. They sell cars. They lose money. Not a good business. Procter & Gamble makes products, sells products to consumers, makes money. Good business. Kind of the easy thing in your head. And that's why I like dividend companies, because it makes me feel better knowing that the business that I now own a piece of, because at the end of the day, that is what you do. You own a piece of the business. That business is making money. And that's really the gist of it. So, kind of without continuing to, ramble on the topic, I just want to wrap it up with, I like to buy companies that will generate dividends for a very, very long time and that will make money for a very, very long time and whose products are always needed. And I reinvest those dividends into the company because they're going to continue to make money. And as they continue to make money, they pay me more money and I give them my money back in the form of a dividend and reinvest it, grow my position, and then collect a paycheck in the future. That's the rough plan. That's why I love dividend stocks. So if you are interested in continuing to follow along with this dividend journey, go ahead and hit the subscribe button, then hit the notification bell, and you will get that bell will ring, and you will see another video here Thursday and then Sunday. But you will also see another episode of the Dividend Journey next Tuesday, and I will see you all in a little bit.